You might feel like homeownership is an increasingly distant dream, despite working hard and saving diligently. This video will explore the core mathematical realities and underlying economic forces that often make owning a home seem unattainable for many, particularly for adults over 34. We will confront the complex figures that shape today's housing market, offering a clear, data-driven perspective without sensationalism. Understanding these economic truths is crucial for your financial planning and future. For individuals aged 34 and above, who might be balancing careers, families, and other financial responsibilities, the challenges of entering the housing market are particularly acute. This analysis aims to provide clarity on these pressing financial hurdles, empowering you with knowledge. In this video, we will meticulously examine the disparity between income growth and home price appreciation, the escalating costs associated with mortgages and property taxes, and the impact of broader market dynamics. Our goal is to present a comprehensive, factual overview of the current housing landscape, providing verifiable insights rather than empty promises about easy solutions. My background in real estate analytics and market research informs this discussion. While I don't claim to possess magic answers, my experience involves analyzing countless data points and economic trends within the housing sector. This enables me to break down complex financial concepts into understandable components for you. To truly grasp why homeownership feels out of reach, you first need a solid foundation in the historical context of housing affordability. We must understand how we arrived at this current economic juncture before diving into the specific numerical challenges that confront potential buyers today. Historically, the trajectory of homeownership was largely predictable, with home prices appreciating steadily in line with average wage growth. For decades following World War II, a single income could often comfortably support a mortgage payment, reflecting a more balanced economic environment. This established a societal expectation that homeownership was a natural progression. However, fundamental economic concepts surrounding housing have drastically shifted over recent decades. What was once primarily a shelter, a home, has increasingly become a financial asset, subject to investment speculation and global capital flows. This transformation has profound implications for average citizens simply seeking a place to live and build equity. There are varied perspectives on this shift. Some argue it's a natural evolution of a growing economy, while others point to systemic issues. We must consider both views: the supply and demand pressures exacerbated by urbanization, alongside the financialization of housing that prioritizes investor returns over community well-being. Both play a role in the current affordability crisis. Imagine housing as a tree. In the past, its growth mirrored the growth of the forest around it. Average incomes. Today, the tree's growth has accelerated independently, driven by nutrients from external sources, making it difficult for the average person to keep pace. This analogy helps illustrate the widening gap we now face. This divergence between the tree's growth and the forest's growth isn't just a metaphor. It's rooted in verifiable economic data and policies. To understand the current mathematical obstacles to home ownership, we need to consider how broader economic forces, like inflation and monetary policy, have fundamentally altered the equation. Inflation, often perceived as a general increase in prices, has a particularly potent effect on the housing market, amplifying costs at every stage. For years, low inflation rates seemed to stabilize prices, but recent surges have dramatically impacted everything from construction materials to labor, directly pushing up the cost of new homes. This directly affects the entry point for you. Monetary policy, specifically interest rate adjustments by central banks, plays an equally critical role. When interest rates are low, borrowing becomes cheaper, often stimulating demand and driving up home prices. Conversely, higher rates, while intended to curb inflation, make mortgages significantly more expensive, impacting your monthly payments and overall affordability. These policies, sometimes implemented to stimulate economic activity, can inadvertently create bubbles or exacerbate housing scarcity. For instance, quantitative easing measures inject liquidity into the financial system, which can find its way into real estate investments, further inflating values beyond the reach of average wage earners. Think of it like a seesaw. One side represents your income and savings, while the other represents home prices and borrowing costs. Monetary policies often add weights to the housing side, making it much harder for your side to lift it. This constant rebalancing acts against aspiring homeowners, making progress feel elusive. Understanding these macroeconomic levers is essential because they form the unseen hand guiding the housing market. They don't just affect prices, they dictate the financial landscape you must navigate. Now, let's dive into the concrete numbers that reveal the actual magnitude of this challenge, starting with the stark reality of income versus home value growth. The most fundamental mathematical barrier to homeownership is the stark divergence between median household income growth and median home price appreciation. For decades, home prices have consistently outpaced wage increases, creating an ever-widening affordability gap. You find yourself earning more, but your purchasing power for a home diminishes. Consider the data. While wages have seen modest increases, often barely keeping pace with general inflation, home prices have skyrocketed. For example, national median home prices have increased by over 100% in many regions over the past 2 decades, whereas average wages have risen by only a fraction of that amount. This is not sustainable. This pattern isn't uniform across all areas. Highly desirable metropolitan centers typically experience more extreme disparities, but the trend is prevalent even in less competitive markets. Different job sectors also see varying wage growth, but few have kept pace with the dramatic ascent of real estate values, leaving many feeling behind. Of course, this doesn't mean homeownership is impossible for everyone. High-income earners in specific industries might still find opportunities, especially if they have substantial existing equity or family assistance. However, for the majority of the population, particularly those in the median income bracket, the math presents a formidable and growing obstacle. This relentless upward trajectory of home prices, combined with stagnant real wages, forces potential buyers to borrow increasingly larger sums. This brings us directly to the next critical component of the housing affordability crisis: the burden of interest rates and how they compound the overall cost of a mortgage. The cost of borrowing money through a mortgage significantly impacts total homeownership expenses, often more than the principal price itself. When interest rates rise, even by a small percentage point, your monthly payments can surge dramatically, making homes that were barely affordable suddenly completely out of reach. This directly reduces your purchasing power. For instance, a $400,000 home with a 20% down payment, financed at 3% interest over 30 years, results in a monthly principal and interest payment of approximately $1,350. The same loan at 7% interest, however, jumps to around $1,230, an increase of nearly $800 per month, or $9,600 annually, just in interest. Over the lifetime of a 30-year mortgage, even a modest interest rate difference can accumulate into tens or even hundreds of thousands of dollars in extra costs. This is the hidden math that often surprises first-time buyers. The total amount repaid can be double or even triple the original home price, solely due to interest. While fixed-rate mortgages offer payment stability, variable rate options, though initially lower, expose you to future interest rate hikes. Refinancing can sometimes alleviate burdens, but it's not always an option, and depends heavily on prevailing market conditions and your financial standing at that time. These are the nuances you must understand. Before you even consider monthly payments, there's another significant hurdle that prevents many from entering the housing market: accumulating the substantial upfront capital needed for a down payment. This initial sum often represents years of disciplined saving, only to see the target amount continuously move further away. Gathering a sufficient down payment is one of the most significant initial barriers to home ownership you will encounter. With soaring home prices, the traditional 20% down payment has become an insurmountable sum for many, requiring years of meticulous saving that often feels like chasing a constantly moving target. The required capital grows faster than your savings. Consider a median home price of $400,000. A 20% down payment means you need to save $80,000 plus closing costs that can easily add another 3 to 5%. This translates to needing well over $90,000 in liquid savings before you even qualify for a mortgage. For many, this is a multi-decade savings goal. This down payment barrier disproportionately affects younger generations, those with student loan debt, and individuals from lower-income backgrounds, perpetuating wealth inequality. It forces many to remain renters, hindering their ability to build equity and participate in the very market that is rapidly accelerating out of reach. While programs like FHA loans offer lower down payment options, e.g., 3.5%, they often come with additional costs, such as mortgage insurance premiums that increase your monthly expense. Family assistance can bridge this gap for some, but this isn't a universal solution, highlighting the systemic nature of the problem. Even if you manage to clear the down payment hurdle, the financial obligations of home ownership extend far beyond the initial purchase. Property taxes, insurance, and ongoing maintenance represent a continuous stream of expenses that frequently surprise new homeowners, adding another layer to the complex financial equation. Beyond the mortgage principal and interest, property taxes represent a substantial and often increasing recurring cost of homeownership that you must factor into your budget. These taxes, levied by local governments, can escalate significantly over time, regardless of your fixed mortgage payment, adding unpredictable pressure to your finances. Property tax assessments are typically based on the perceived value of your home, and as home prices in an area rise, so too does the assessed value. This means even if you bought your home years ago, your annual property tax bill could have doubled or tripled, significantly increasing your monthly housing expenditure without any additional benefit. Furthermore, the costs of home maintenance and repairs are often underestimated. From routine upkeep like lawn care and utility bills to unexpected expenses like a new roof, HVAC system, or plumbing issues, these expenditures can easily amount to thousands of dollars annually. Unlike renting, you are solely responsible for all these costs. Limitations in predicting these costs exist. Older homes generally require more maintenance than newer ones, and property tax rates vary wildly by state and municipality. However, it's crucial to budget at least 1 to 3% of your home's value annually for these ongoing expenses to avoid financial distress. These ongoing financial demands are not isolated. They are intricately linked to broader market dynamics that influence home values and the cost of living. Understanding these deeper forces, such as the imbalance of supply and demand, is vital to fully comprehending the systemic challenges within the housing market. A fundamental driver of escalating home prices, often hidden in plain sight, is the severe imbalance between housing supply and demand. For decades, new construction has not kept pace with population growth, urbanization trends, and household formation rates. This creates intense competition for available properties. Driving up prices in a self-reinforcing cycle you experience firsthand. Stringent zoning laws, which often restrict high-density development, contribute significantly to this supply shortage. Lengthy approval processes and increasing construction costs for labor and materials further impede the creation of new housing units, especially affordable ones. These regulatory hurdles effectively stifle the market's ability to respond to demand. Population shifts, particularly the migration towards thriving urban centers and desirable suburban communities, concentrate demand in specific areas. This intensifies bidding wars and price increases in these sought-after locations, leaving peripheral areas often overlooked and exacerbating the affordability crisis for the majority. While some regions might experience more balanced markets or even localized oversupply, the overarching national trend points to a persistent deficit of housing, particularly starter homes and affordable multifamily units. This general scarcity means that even small fluctuations in demand can have outsized impacts on prices. This persistent supply-demand mismatch isn't just an organic market force. It's often shaped by policies and powerful actors. These systemic influences elevate housing from a basic need to a lucrative investment, a dynamic increasingly driven by institutional money rather than individual homeowners. This leads us to question, who truly benefits from this setup? A significant, often overlooked factor influencing your ability to buy a home is the growing presence of institutional investors and corporate landlords in the housing market. These entities possess vast capital, allowing them to purchase properties in bulk, frequently outbidding individual buyers who rely on traditional financing. They are fundamentally changing the market structure. These corporate players often acquire thousands of single-family homes, converting them into rental properties. This strategy shrinks the available inventory for individual homebuyers and, by consolidating ownership, can also contribute to rising rental costs. You're effectively competing against multi-billion-dollar firms. The objective of these investors is financial return, not necessarily community development or providing affordable housing. They view homes as assets, leading to practices that can prioritize profit margins over the needs of residents. This shift has profound implications for the social fabric of neighborhoods and the very concept of homeownership. While individual investors and small landlords have always been part of the market, the scale and impact of institutional capital are unprecedented. This isn't to say all investors are detrimental, but the sheer volume of their purchases creates a distinct competitive disadvantage for you, the average homebuyer. This financialization of housing, where homes become commodities for investment rather than sanctuaries, is a critical aspect when you seek to expose the system that increasingly hinders homeownership. It's part of a larger pattern where the very nature of shelter is being redefined, making it harder for you to secure a stable future. While the challenges of homeownership are clear, it's crucial to acknowledge the often hidden costs and limitations of long-term renting. Many argue that renting offers flexibility and freedom from maintenance, but it also means consistently contributing to someone else's equity without building your own. You are paying a mortgage, just not your own. Rising rents are a constant concern for renters, often increasing annually and outpacing wage growth in many areas. This creates financial instability and makes long-term budgeting difficult, as your largest monthly expense is subject to external market forces. You lack control over your housing costs. Furthermore, renting means you miss out on potential wealth accumulation through home equity and tax benefits associated with home ownership. The money spent on rent could, in an ideal scenario, be contributing to an appreciating asset. This opportunity cost is a significant hidden expense of renting over many years. Of course, renting provides advantages like flexibility to move, no responsibility for repairs, and sometimes access to amenities you might not afford as a homeowner. These benefits appeal to certain lifestyles or those in transient career phases. The decision between renting and buying is multifaceted and highly personal. Understanding the full financial picture of both renting and buying is essential for informed decision-making. By analyzing the true costs, both direct and indirect, of your current housing situation, you can better navigate the complex landscape and identify opportunities, even within a challenging system. Given these complex realities, the first practical step you can take is to meticulously refine your personal budgeting and financial literacy. Understand every dollar coming in and going out, identifying areas where savings can be maximized without sacrificing essential quality of life. Knowledge is your most powerful tool in this environment. Explore reputable resources for financial education, such as nonprofit credit counseling agencies, online budgeting tools, and reputable financial advisors specializing in real estate. Government-backed programs designed to assist first-time homebuyers with down payments or closing costs, though limited, are worth investigating thoroughly. Be realistic about the timeline and effort required. Achieving homeownership in this market is an incremental journey, not a quick fix. Celebrate small victories in your savings goals, understanding that sustained effort over several years is often necessary. Patience and persistence are critical virtues in this quest. We invite you to share your own budgeting strategies and challenges in the comments below. Hearing diverse experiences and creative solutions from others in our community can provide valuable insights and foster a supportive environment for navigating these difficult financial decisions together. Beyond individual financial planning, it is also crucial to consider what alternative housing models exist. These innovative approaches can offer different pathways to stable housing, providing valuable options outside the conventional single-family home purchase that dominates the popular imagination. As conventional homeownership becomes increasingly challenging, exploring alternative housing solutions can offer viable paths to stability and equity for you. Consider options such as co-ownership, where multiple individuals pool resources to purchase a property, thereby reducing individual financial burdens and shared responsibilities. Investigate the feasibility of tiny homes, modular homes, or even multi-generational living arrangements in your area. These alternatives often come with significantly lower upfront costs and reduced ongoing expenses, making homeownership accessible where traditional options are not. Research local zoning laws and community acceptance for these unique structures. It's important to be realistic. These alternatives each come with their own set of trade-offs, from limited space to complex interpersonal dynamics in co-ownership. However, they can provide genuine benefits, like lower environmental impact, increased financial freedom, and a strong sense of community for those willing to adapt. We encourage you to research specialized lenders or community land trusts that support alternative housing models. Engage with local housing initiatives and advocacy groups that promote diverse housing options. They often have resources and networks that can guide you through these less traditional paths. While personal adaptability is key, many of the issues we've discussed stem from systemic flaws. True, lasting change often requires broader advocacy and collective action to address the root causes of the housing crisis, prompting us to actively engage with policy and societal structures. To truly address the core issues, it's vital to move beyond individual strategies and engage in advocacy for systemic change within the housing market. Understanding housing policy, land use regulations, and investment practices allows you to contact your representatives with informed perspectives, demanding meaningful reforms. Seek out and support housing advocacy groups, nonprofits, and policy research organizations dedicated to improving affordability and access. Participate in local government meetings, particularly those concerning zoning, development, and affordable housing initiatives. Your voice, combined with others, can amplify the call for change. Be realistic that systemic change is a gradual process, often requiring sustained effort over many years. However, collective action, informed by a deep understanding of the issues, has the power to influence public policy and reshape the housing landscape for future generations. Your engagement contributes to this vital work. This is where you can actively participate to expose the system that often prioritizes profit over people. By understanding and challenging existing policies, you contribute to a movement demanding a more equitable and accessible housing market for everyone. Your actions can inspire others to join the cause. While advocating for broader shifts is crucial, it's equally important to maintain a mindset that empowers you in your personal journey. What immediate shifts in perspective can help you navigate the current landscape with greater resilience and determination, regardless of the systemic challenges? In conclusion, the journey to homeownership today is undeniably complex, far removed from the simpler economic landscapes of past generations. You've seen that the math they're hiding isn't an obscure secret, but a combination of income stagnation, soaring property values, escalating interest rates, and systemic market forces. These factors create a formidable challenge. We've explored key challenges: the widening gap between earnings and home prices, the compounding effect of interest rates, the barrier of down payments, and the ongoing costs of taxes and maintenance. We also uncovered how market dynamics, like supply-demand imbalances and institutional investment, further complicate the picture for you. Therefore, approaching homeownership requires realistic expectations, diligent planning, and often significant adaptation. It's not about giving up, but about being fully informed of the uphill battle. Success in this market demands patience, financial discipline, and a willingness to explore non-traditional paths when necessary. We invite you to share your perspectives and experiences in the comments section below. What strategies have you found effective? What challenges have you faced? Engaging respectfully in this conversation helps to build a community of informed individuals navigating these critical financial decisions together. Understanding these multifaceted challenges is the first step towards empowering yourself. But what if there was a way to take this newfound knowledge and use it to strategically plan your future, regardless of whether immediate homeownership is feasible? This leads us to our final, empowering takeaway. The genuine value delivered by this discussion is a clearer, unfiltered understanding of the profound realities shaping today's housing market. You now possess the knowledge to see beyond conventional narratives, equipped with the critical math that truly dictates who can and cannot afford a home in the current economic climate. This isn't just about dispelling myths. It's about equipping you with the factual foundation needed to make genuinely informed decisions about your future housing and financial strategies. Whether you ultimately buy, rent, or explore alternative solutions, your choices will be grounded in a more complete economic picture. This comprehensive overview empowers you to navigate the housing market strategically, making decisions that are aligned with your financial capacity and long-term goals. It's about taking control of what you can control: your knowledge, your planning, and your approach to a complex system. If this deep dive into the underlying math of homeownership resonated with you, and you found this discussion valuable, please consider subscribing to the Sistema Immobiliaria channel. We consistently provide more insights into the complex financial landscape, helping you stay informed and empowered. Ultimately, your journey through the housing market is unique. Armed with this knowledge, you can approach the challenges with clarity, strategic intent, and a renewed sense of agency. Continue to learn, adapt, and advocate for a future where housing is more accessible for all.